Hello and welcome to week 29. This is the finance session. We are going to cover three different topics today, and that's the three sheets that you should be comfortable with when it comes to knowing your business's finances. And we're going to cover a couple other topics in there, but each video this week is going to cover one of those financial sheets that you should know. First one's going to be income statements. Then we've got the balance sheet, and statement of cash flows is third. So let's get started. There really isn't that much that you need to know in terms of finance, in terms of understanding your financial sheets, because all the numbers you should be aware of. And it seems intimidating. A lot of people don't like to look at their numbers because they don't really understand them, but there's really nothing in there that, that should be a surprise to you. It's like just some basic calculations. There's nothing crazy in any of these that's outside of like addition and subtraction. We're going to get into some ratios on the second video, but outside of that, it's just some basic math, and they're going to give you a lot of information that you can use to improve your business. It really isn't about numbers though. It's about investigating what makes those numbers what they are. So that's what should be appealing to you, is understanding that, what goes into your expenses, your revenues, your retained earnings, like all of that stuff, like the numbers really should be the investigative part, should be the interesting part to you. And when we're talking about all of this, especially when you've been in business for a couple of years and you want to compare against previous periods, previous years, corresponding to the previous year. So you want to look at your busy season this year versus last year, your slow season, this year versus last year, et cetera. Compare months, weeks, whatever that is. In certain industries, there's certain weeks of the year that are busier than others, but those weeks don't always correspond to the same week. So week 22 this year might be really busy, but week 22 last year wasn't, because that event that occurred in week 22 this year happened in week 23 last year, et cetera. We're going to start off with the income statement, which also is called the profit and loss statement, or your P&L, which is something that is one of it's probably the most popular sheet that people look at, and they just want to look at their P&L. They want to go straight down to the bottom and see what their net profit is, which is great. There's a lot more that goes into that, but all this is in the income statement is it's where you got your money and where you spent it. That's all the P&L is telling you. So you're going to have your revenue, adjusted revenue minus your costs and expenses, minus taxes, interest, depreciation, et cetera. That's going to leave you with your net income at the bottom. And most business owners, like I said, stop right there. That's as far as they want to go. They want to say, okay, I've got a positive net income. I'm profitable. Cool. That doesn't necessarily mean that your business is profitable or that you are successful. Having a negative net income is possible, and you can still be successful. We're going to get into that. When you're going through your income statement, you want to review your biggest costs and expenses, and those are the variable costs, to make sure that they make sense compared to your revenue. So a lot of things like, for instance, labor or your cost of goods, that's going to be a variable cost. That's going to change based upon your revenue. There's going to be the fixed ones like rent, which it's something that regardless if you are, making money or not, you're still going to have to pay rent. You're still going to have to pay certain dues, subscriptions. Taxes will fluctuate based upon your revenue. So the ones that you can control are going to be those ones that are more variable, that are tied to something like revenue. So there's always exceptions to the rules, but generally when revenue goes up, your labor goes up, your costs go up. Revenue drops, those should also drop correspondingly, in comparison to whatever it is, whatever that percentage is. So if your labor is supposed to be at 20%, regardless if you are, selling $1 million or $10 million, your labor is going to be 20%. There's ways that you can adjust that. And, that comes with process improvements, understanding your processes, all that type of stuff. But that's not what we're talking about here. We're just understanding what the numbers mean. What you're really looking for is anomalies between the periods. So if your cost of goods was 20% this quarter, this year, and then last year it was 25%, where did that drop come from? Why did it drop? Did you make a better deal with a vendor? Did you become more efficient? Did you fire that employee who is stealing all of the, your product, whatever it was? You want to know why those changes in the numbers happen. And you want to look more at percentages, because if I have cost of goods of $30,000 this year and it was $50,000 last year, that doesn't mean anything if it's not connected to something like revenue. So make percentages where you can, so that you can compare apples to apples when you're looking at your income statement. So that's it. Up next is going to be balance sheet and financial ratios.